ARR, the magic number, the rule of 40, GPM, ROI, etc., etc. Investors and indeed financial advisors like myself, we really love our jargon. Hello again. I made a series of videos for LinkedIn last month on various aspects of the decision-making process that investors use when they're looking at opportunities to invest. I've had some feedback on those, most of it positive, thank you very much. But I've also had a couple of requests from people. One in particular was, can I please try to explain some of the key financial measures or metrics that investors will use when they're considering an investment in a tech or a media company? I have 5 that I'd like to try to explain to you today. Maybe another way of asking that question would have been, can you help demystify or decode some of the jargon that investors and their advisors use? The first one I'd like to touch on is ARR, or annual recurring revenue. It's very simple. ARR is a measure of the amount of subscription revenue you get. Why would they look at this? Well, it shows that there's a hierarchy, or there's a view that some revenue is of better quality than other revenue. Subscription revenue is seen as the best quality revenue because it's predictable, because it can be seen as certain revenue or near certain revenue. So subscription revenue is definitely seen as better quality and therefore will command a better valuation than, for example, license and maintenance fees, which in turn are seen as better quality than once-off revenue. Once-off revenue, such as consulting or installation revenue, is seen as maybe the poorest quality revenue within a tech and a media business. So as well as the absolute measure of IRR, the investors will look at momentum. They'll look at the growth rate of that ARR. And what they'd like to see is that the mix of revenue will improve. So as well as growing in absolute terms, within that growth, you'll see a higher percentage of that revenue coming from better quality revenue, a revenue that's predictable, such as subscription revenue. The second one I wanted to touch on was sales efficiency. And sales efficiency is really a very simple measure, but sometimes difficult to calculate, which is for every dollar that I put into your business, how much more sales can you do? So if I put $1 in and you do $1.5 of increased sales because of that, well, that's a great indication that this is a good business to invest in. Obviously, most investors would like to see sales efficiency ratios above 1. I have seen for early stage investments that they'll sometimes look at something below 1, but very rarely would they look at something that wasn't as good, wasn't better than 0.75, for example. The next one I wanted to touch on was cash and cash burn. An investor will absolutely ask you, particularly for early stage investments, how much cash are you burning on a monthly basis? So how much cash do you need from outside sources over and above your revenue to continue with your operations, to continue to pay your bills? And essentially what they're looking for then when they ask you how much cash have you got on hand, they're trying to calculate what your roadway or runway is. How many more months of business without investment can you stay in business? So cash burn, and cash on hand, and therefore your runway is really important for investors. The fourth point that I have is, what about profit? Well, obviously investors are looking for businesses that are profitable, and it would be fantastic when you go out and look for investment if you're already generating a net profit. However, many early stage tech companies are at best break even, or sometimes on a net basis are a little loss making. In those circumstances, the gross profit or the gross profit margin, GPM, is critical. They'll want to see a fairly high profit once you've taken away your cost of goods sold. A cost of goods sold is essentially all of the direct costs associated with producing your product. If that percentage is reasonable, I would say something at least 40%, then the pitch to the investor is, we can get to net profitability if you give us the money, because we can get to scale. We won't grow our administration expenses as quickly as we would grow other costs, and therefore we can get to a net positive margin position. That's a really difficult pitch to make unless your gross profit margin today is reasonable. Like I said, something 40% or above. Yeah. The last one that I wanted to touch on was the rule of 40. To be frank with you, this is a little bit gimmicky, but essentially it's a simple principle. They look at your percentage growth on your top line, how much your revenue is growing, and also your net profit margin. If those two in combination are above 40, that's good. The reason I say it's a little gimmicky is that if I saw a business, for example, that had growth rates of 38% and had a net margin of 3%, it would tick the box in terms of the rule of 40. But a net margin of 3% on a business isn't brilliant. However, it does point to a couple of things. One is the kind of fundamentals that an investor will look for is obviously, is this business growing and can it grow quicker because of my investment? And is it profitable today, or at least does it have a path to profitability? Therefore, can it spit out cash in 2 years, 3 years, 5 years time? And when I exit, I can exit at a multiple when I sell the business and get a multiple on my investment. Well, then that's certainly something that most investors will look at. I hope this has helped. I will be doing some more videos in the new year. If you have any suggestions or any questions, very happy to take any communication directly on LinkedIn. Thanks very much and look forward to speaking to you soon. Bye.